but you're making it work for you. You could rent it out or sell it for a higher price in the future. This is the essence of real estate investing. But like any investment, real estate has its ups and downs. One key advantage is that it can provide a constant cash flow. If you rent out a property, you can receive a steady income every month. It's like having a business that keeps generating revenue. Plus, as property values increase over time, so does your wealth. Another advantage is the tax benefits. Depending on where you live, you might be able to deduct mortgage interest, property taxes, and costs associated with maintaining a rental property. However, real estate investments are not without their disadvantages. They require a significant amount of capital to start. Buying a property can be costly, and you also need to consider maintenance costs, taxes, and insurance. Plus, unlike stocks or bonds, you can't sell a property immediately if you need cash. Moreover, the real estate market can be unpredictable. Property values can go down as well as up. And if you're depending on rental income, there's always the risk of vacancies or non-paying tenants. Despite these risks, real estate investing can be a great way to diversify your portfolio. It's a tangible asset that you can see and touch, unlike stocks or bonds. And over the long term, it can provide a good return on investment. So, if you're willing to do the research, understand the market, and take on the responsibilities of a landlord, real estate investing can be a rewarding venture. Real estate can be a lucrative investment if done correctly. In the digital age, even money has gone virtual. Yes, we're talking about cryptocurrencies. In the simplest of terms, cryptocurrencies are digital or virtual currencies that use cryptography for security. This makes them immune to government interference or manipulation, giving them an edge of decentralization. Cryptocurrencies like Bitcoin, Ethereum, and thousands of others operate on technology called blockchain. Think of blockchain as a digital ledger of transactions spread across millions of computers. This technology ensures the integrity and anonymity of transactions, making it nearly impossible for hackers to disrupt the system. Now let's talk about the elephant in the room: volatility. Cryptocurrencies are notorious for their price swings. Bitcoin, for instance, has seen its value fluctuate from just a few cents to nearly $65,000 within a span of a decade. This volatility can be a double-edged sword. On one hand, it can lead to significant gains if you buy low and sell high. On the other hand, it can also lead to substantial losses if the market moves against you. Investing in cryptocurrencies can be rewarding, but it's not without risks. Since the market is relatively new and unregulated, it's susceptible to market manipulation and fraud. Additionally, the lack of a physical commodity backing cryptocurrencies makes their value largely speculative. This means that if investor confidence wanes, the value of your investment could plummet. Cryptocurrencies are also subject to regulatory risk. Governments around the world are grappling with how to regulate this new form of currency, and their decisions could have a significant impact on its value. A government ban, for instance, could lead to a massive sell-off. Despite these risks, many investors are drawn to cryptocurrencies for their potential for high returns. They also offer a new way to diversify your investment portfolio. However, it's crucial to remember that cryptocurrencies should only be a small portion of your investment portfolio, given their high-risk nature. Cryptocurrencies are a high-risk, high-reward investment. Always do your research before diving in. Remember, investing is not a sprint, it's a marathon. Be patient, stay informed, and most importantly, don't invest more than you can afford to lose. No investment comes without risk, but there are ways to manage it. Let's talk about risk management and diversification. These two concepts are like the protective armor of your investment portfolio. They help shield you from the unpredictable swings of the market and can soften the blow if things don't pan out as expected. Risk management is all about understanding the potential pitfalls of your investments and taking steps to mitigate them. It's like wearing a safety helmet when you ride a bike. You might not crash, but if you do, you'll be glad you had it on. Similarly, in investing, risk management tools and strategies help prevent your portfolio from taking a nosedive when the market gets rocky. Now on to diversification. Ever heard the saying, don't put all your eggs in one basket? Well, that's exactly what diversification is all about. It's the practice of spreading your investments across various asset classes, sectors, and geographical regions. This way, if one sector or asset class underperforms, it won't wipe out your entire portfolio. Instead, you'll have other investments that may be performing well, helping to balance out any losses. Think of it like a seesaw. If all your investments are on one side and that side goes down, the whole seesaw crashes. But if your investments are evenly distributed on both sides, one side can go down without causing a total crash. It's also important to diversify within asset classes. Let's say you've invested in stocks. Rather than investing in just one industry, you could spread your investments across several industries. This way, if one industry struggles, you've got others that could still be thriving. So as you build your investment portfolio, keep these two principles in mind. They are the safeguards that can help ensure your portfolio stays strong, even in volatile market conditions. Remember, don't put all your eggs in one basket, diversify. Investing is not a get-rich-quick scheme. It's a marathon, not a sprint. This mantra holds especially true when we talk about long-term investment strategies. Taking the long view means playing a different game, one that's about patience and steady growth rather than quick wins. Consider this, you're planting a seed. It doesn't grow into a giant oak tree overnight. It takes time, nurturing, and a whole lot of patience. That's what long-term investing is all about. It's about understanding that wealth is built incrementally, and it's about being patient enough to let your money do the work for you. There are a multitude of strategies for long-term investing, and they all share a common theme: patience. Whether it's investing in stocks, bonds, real estate, or cryptocurrencies, the key is to have a strategy and stick to it, even when the market gets rough. With patience and smart strategies, your money can grow significantly